everyone, good evening. It's 5 p.m. on the clock, which means it's time to kickstart Rise with India Prime Time. I'm Mubina Kapasi, and as always, we're doing so with the Money Show, which is your one-stop destination for all your personal finance matters. Today, here's what we have lined up for you. First up, just 2 days left to fill your advance tax amounts. Remember, this is the second installment of the advance tax that you will have to fill. Are you liable to fill advance tax? And if so, how do you calculate that the amount that you have to fill is correct? That's what we will understand. Also, after this topic, we will be talking about the power of compounding. The longer you sip, the more you'll profit. That's what a recent report suggests. And, well, the probability at least of having negative returns diminishes to near zero by the time you reach the 5th year of doing your SIP. That's what we will be discussing. And finally, some very interesting findings by Hurun Institute, which believes that the Audi and the BMW are still the favorite brands of the uber rich of India. We are going to tell you how the super rich Indians invest and spend their money. All of this today on The Money Show. But first, a quick look at the headlines. Markets pick up steam. Favorable global cues help benchmark indices close in the green, with the Nifty reclaiming 11,050, Sensex gaining 280 points, and all sectoral indices barring pharma ending higher. The government looks to push the pedal on strategic stake sale. List of 3 to 4 possible candidates for strategic divestment drawn up. Shipping Corporation, Concor and Pawan Hans top the list. If the plan falls in place, the government is keen to offload the entire stake in Shipping Corporation. And here's another big ET Now exclusive. The government is mulling sweeping policy changes to reform the coal sector. High-level panel recommends significant privatization of the sector, and suggestions include doing away with direct allotment to PSUs to remove the private sector's disadvantageous position. The government attempts to walk the talk on Air India divestment. Rules for expression of interest coming soon, sources say. Debt overhang could be cut down significantly as the government seems keen to exit the airline completely. Bharti Airtel is back yet again in fundraising mode. Sources tell ET Now that the telecom giant is planning a $2 billion optic fiber invade in a bid to fight out rival Jio. That's another ET Now exclusive. The International Monetary Fund sounds a note of caution, says India's economic growth much weaker than expected. Regulatory overhang and NBFC worries mean risks to the outlook tilted on the downside. Odd even is back in the National Capital Region. Arvind Kejriwal government will introduce the odd even rule come November, when the pollution level picks up. Also comes with a 7-point agenda as a precautionary measure. Well, those are the headlines we are tracking for you at this hour. But first, topic 1, and that is filling your advance tax. Now, you guys may be thinking, hey, I just filed my income tax return. Well, taxation is an ongoing process, and when you pay your final taxes, you have to make sure that you do it in installments. First installment was due on the 15th of June. Now, the second installment is due on the 15th of September. The question is, are you as well liable to pay advance tax? And if yes, how should you calculate the amount of advance tax that you will have to cough up this time around? To understand all of this and of course to answer all your questions and queries that you guys may be having on taxation, I have with me Surabhi Marwah, partner of People Advisory Services with EY India. Surabhi, thank you for joining us on The Money Show. And I'm sure this is a question on a lot of people's minds who thought that they just struggled through the entire process of filling their income tax return, and there's yet another taxation process that they have to fulfill. So tell us, does every individual out there have to pay advance tax?
Thanks, Mubina. Very nice to be here. I know it's, you said it right, we just finished the tax returns and we have yet another tax deadline, but that's how life goes. Yes, a lot of individuals have to pay advance tax, just a couple of exceptions. If your tax liability after deducting any TDS, TDS is what your employer deducts, what is deducted month on month from that paycheck, the right side column, and any other foreign tax credit or that you have exceeds 10,000 rupees, then you are liable to pay advance tax. The only exception therefore is one, if your advance tax liability is less than 10,000 rupees, and two, if you are a senior citizen and you have no business income, then whatever be your tax liability, after adjustment of TDS, you do not have to pay advance taxes. So those are the only two exceptions to payment of advance taxes.
Okay, all right. The second question naturally is that how do you pay the advance tax? How do you know what's the correct amount? Because the fact is that I don't know what my total income is going to be. If I'm salaried, yes, maybe I do. But if I have a business, obviously I'm not going to know what my total income is going to be by the end of the year. So how am I to know what's my total tax going to be? So in such a scenario, how do you calculate what that 45% odd amount that I am liable to pay by the 15th of September is going to be, Surabhi?
So it's a process of estimation. So I'll take an example. Let's assume you have 2 or 3 sources of income. One is, let's forget about salary for a moment. If you have interest, you have rental income, and you are expected to get you're expected to redeem some mutual funds or sell some property. Now, what you have to do at the beginning of the year is estimate how much interest you'll earn during the year. Now, you can do it on the basis of what you earned last year, or a quick estimation of what the banks, like a FD into the amount of interest. If you have a rental agreement, you've signed a lease, you know what you're going to earn in terms of rental, so you do a quick math around it. You estimate that for the year. You then calculate the total amount of liability that you have. If any payer of income has deducted any TDS, for example, the bank, etc., then you reduce that and you come out with a residual tax liability. You work that out, you work out the installments on that basis. So 15%, 45%, etc. Now, if you have any income which is one time, for example, you are selling some mutual funds and you've sold them on, say, 4th of September, in that case, your advance taxes for those that particular class of income or capital gains is only to be paid in the next few installments. So as a rule, income that is known for the whole year, estimate that for the year, deduct any TDS that the payer would have deducted for you, and you'll get that TDS amount from the Form 26AS, and you can extrapolate it and work out the balance. If there is any one-time income, then pay the advance tax on that one-time income in the remaining quarter. So that's how you're supposed to do it.
Surabhi, let's say that I have missed my first deadline. Let's say I did not pay any advance tax on the 15th of June, because you guys have not been watching The Money Show when we as well reminded you to pay your advance tax. So let's assume that, they missed their first deadline. So what should they do now? Should they pay off the entire 45% amount in bulk on the 15th of September, before the 15th of September?
They should definitely pay off the entire 45% as on or before the 15th of September. They can do so. However, one little piece of bad news, that they will have to pay interest at the rate of 3 months, because the installment on 15th of June was missed. So whilst you can pay off the 45%, which is 15% due on the 15th of June, and the remaining 30% that is accumulated now on 15th of September, but there will be an interest liability, and that will be for 3 months. And that's a mandatory liability. So for those of you who haven't watched the Money Show, as Mubina said, you're going to have to cover up the interest. So please do watch the Money Show going forward.
Oh, that's Surabhi. And you know, let's assume a situation like where I incorrectly assess my income. It's an error, right? A human error. And at the end of the year, my income is a little higher. Will the department still penalize me that why have you not made, you know, that certain percentage, that 95 or 100% of your advance tax payment? If I'm not mistaken, I think it's 90%. Please do correct me if I'm wrong with that, Surabhi. Will the department penalize me then that, you know, we have had a shortfall in your advance tax because you did not, because I know on my part that I did not correctly assess my income, or maybe I got some sort of a windfall gain of sorts, maybe inheritance or something like that, you know, in the second half. Will I be penalized even then by the government?
So the government gives you enough time, so 4 installments to pay off the tax. If you don't pay 90% by 15th of March, it's only then that 1% interest, it's called 234B, is levied. So you have enough time to pay off the 90%. It's almost till the end of the fiscal year. But if that 90% is not done, windfall gain or other notwithstanding, then the interest is to be charged. Now you can argue it out, but upfront the law very clearly says if 90% not paid, then tax interest has to be charged at the 1%.
This should be sort of a factor that our viewers should, you know, be relaxed about. But is there any cap on the total interest that the department can charge me if I have not paid advance tax or not paid 90% of my advance tax by the 15th of March?
It's not there's no cap. You just, you know, there is just the 1% that you charge on the tax not paid. So that's how the calculation or the math is done. There is no upper cap as to how much the total interest can be. No quantum of upper cap. It's a math formula, 1% tax not paid, and that's about it.
And on, unless you, of course, pay. Another question, Surabhi, and we get this quite often. What's the difference between advance tax and self-assessment tax, Surabhi?
Okay, so both of them are taxes that you have to pay to the government. Advance tax is tax that has to be paid in 4 installments during the financial year. So this is 4 installments within the financial year in June, September, December and March. If you realize that you haven't paid these 4 installments, or like you said, Mubina, I thought I've paid all my advance tax, but when my tax preparer does my tax return, there is another little bit of tax to be paid. Then that tax is called self-assessment tax. So that's the difference really is just that advance tax is paid within the 4 quarters or within the fiscal year concerned, while self-assessment tax is paid after the end of the fiscal year. The method of payment is pretty much the same. You just select a different category, advance tax versus self-assessment tax, but it's really when you pay it, that's really just the difference.
Okay, I think that's like a complete A to Z of advance taxes. It's a very simple topic essentially, but you know, it's important to once again remind all our viewers that not today, but you have 2 more days. That's Sunday, before which go online and pay off your advance tax or there will be a penalty, and there's no cap. Mathematical formula, 1%, the government will keep charging you, so it's important you pay it off. Okay, you know, at this point I'm going to invite all our viewers out there who have any questions or queries on taxation to write into us on the Money Show at etnow.tv, or you can join us live on the phone call. We have Surabhi Marwah, who is of EVA. It's a golden opportunity, folks, to get your questions answered by Surabhi Marwah. So call in, 24990388 is the number as well that you could connect with us on. That's flashing on the top of your screens. But let's answer some questions for now that we have received via email. First up, we have Monterey, who has written in to us saying, I am a salaried professional and my employer, that's an MNC, has been deducting TDS. So do I still have to pay advance tax? And that is essentially the question that, you know, Monterey is asking. So, Surabhi, I know you mentioned that after deducting TDS, if your taxation payable will be more than an amount, then you have to pay advance tax. Unfortunately, Monterey has not written what her, you know, her income is or how much TDS is being deducted. But if you could just sort of help Monterey out with her question.
Sure. So, Montre, if salary is your only source of income, then your employer, the MNC employer, should have been doing tax deducted at source or TDS, and therefore there is no advance tax to be paid. If, however, you have income which is different from salary, like I said, interest, rental, dividends above a certain category, then you need to estimate that and then pay advance tax if your liability, like I said, is more than 10,000 rupees after considering any TDS that has been deducted on this residual income. So if salary is your only income, don't worry, the employer should have done TDS, and therefore there should be no advance taxes payable. So if you're worried about the employer not having done TDS, you can check with them, but that doesn't seem to be a probability since you said it's an MNC and they're very well aware of the TDS rules.
Yeah, if you're working in a big corporate, they usually will be aware and they'll be duly deducting their TDS because they as well want to avoid all the hefty penalties that come along with, not deducting or not filling it with the government. So you need to be rest assured. But yeah, if you have any other sources of income, then consider that. See how much tax you'll have to pay on that. And if that exceeds 10,000 rupees, then make sure you file or rather fill the advance tax amounts that's due on the 15th of, every month or on a 3-monthly basis. Okay, we have another very interesting question from Sunena Podar. She's actually written into us saying, should I consider the ATC deductions when calculating the advance tax for this year? Reminder for all our viewers out there, ATC of course is the LIC premium payments, the school fees that you may be paying for your kids, the PPF deposits that you may be making, provident fund payments, etc. that you may be making. And it's a valid question because naturally, because of these deposits, your taxation amount reduces. So, Surabhi, when I am sitting down with pen and putting pen to paper and calculating my total income for the year, am I supposed to be making all these deductions?
So if your income, again, I'll refer back to the same question that Montre had earlier. If your employer, if you have salary income as well, and if your employer has considered ATC, because every employer will be asking you in a declaration to declare this, then you don't have to consider it again. If, however, one, your employer has not considered ATC deductions because you didn't give them in or for some other reason, or if you don't have salary income but other income, then yes, very much you should consider these deductions and then work out the residual tax liability. So just to summarize, if ATC information has been given to the employer and you have salary, then it should be considered and you don't have to consider it again. If they haven't considered it for some reason, or if you have other income except from salary, then yes, please do consider it within the limits allowed.
All right. I hope, Sunena, that's helped your question. And I hope, it'll be easier for you now to essentially go ahead and fill your advance tax amount on the 15th of September. Okay, let's take on board our third question. Fateh Singh has written into us saying, how should I calculate my advance tax figure if I'm considering changing my job? I'm not sure about the income I will get in my new job. Can I pay the advance tax only on the next due date? So he doesn't want to pay it on the 15th of September. Maybe 3 months later when he'll have his new offer letter, etc. in his hand, he'll probably try and squeeze all the payments in on the 15th of December. I suppose, Surabhi, he will risk then that interest or the penalty essentially. But yeah, he's in a situation where, like we mentioned, we don't know what the total income is going to be. So in such a situation, what would you recommend Fateh should do?
So, Mubina, Fateh talked about employment. So, if he's changed his employment, then again, the first employer would have done TDS and the second employer would also do TDS. And so, therefore, he doesn't need to really worry about advance tax if his only worry was his salary income, because both employers have to be both employers will do TDS. Just a word of caution to you, Fateh, you must let your second employer know what deductions you've given in to the first employer, and maybe give them your Form 16, no, the Form 16 won't be available, but give them details of the tax deduction from the first employer, because in your case, the issue really isn't advance tax. It's because the first employer considers slab benefits, he or she considers ATC deductions, and if the second employer also considers all of this again, then you may have a problem, because then at the end of the year, your tax liability, you have a tax liability to pay because both of them have considered certain mandatory deductions. So for you, advance tax shouldn't be an issue unless you have other residual income, which as I said, you need to estimate. If it's only salary income, word of caution, let your second employer know what slab benefits, what ATC deductions and other maybe housing loan interest deductions the first employer has taken, so that the second employer does not take it again. If you feel that both employers have taken it, then yes, please estimate your advance taxes and do your calculation and pay it at the earliest to avoid interest.
All right. Okay, that's an important point to note. I think more than advance tax, you need to ensure proper communication to your new employer as well regarding your tax slab, because you don't want a case of a big tax liability. But at the same time, you must ensure that he's not excessively cutting TDS as well. And in fact, for that matter, all our folks out there, ensure that you properly report all the investments you're making, tax deductive investments that you're making, because why should your employer, deduct more money than they really need to from your salary? So that's important to note as well. Okay, we've just received a question from Sanjeev Singh right now. Okay, it's at the risk of sounding repetitive, but I suppose for the benefit of Sanjeev and maybe some of our viewers who may just be tuning in, his question is, does a salaried person need to pay advance tax as the employer deposits the TDS amount at regular intervals? So like I said, Surabhi, it's at the risk of sounding repetitive, but if you could just once again reiterate, because a lot of our viewers, of course, out there too may be salaried and they have a similar question.
So Mr. Singh, if salary is your only source of income, then you need not worry. You can have a very peaceful weekend, because your employer definitely has to do TDS with month on month, and there are dates mentioned in the income tax law. So don't worry at all. If you have income other than salary, interest, rentals, etc., then yes, you do need to pay advance tax after you do an estimation. I'm assuming you're not a senior citizen and your liability will be 10,000 rupees and above. So if it's only salary income, please feel free. Your employer would have done the needful and is required by law to do the needful.
Okay, all right. Let's move on and take on board another question, not related to advance tax, but it's a very interesting query. Abhay Rajhans writes into us saying that I had a plot of land in a metro city which is now being exchanged with a ready residential flat. While registering the deal, the builder has recovered the tax money, or essentially he's deducted TDS and paid it to the government, which he says he can claim in his income tax return. It will appear in his Form 26AS as well. His question is whether he will get this amount as IT, as the refund tax liability is already arranged for, and that there is no additional income to be taxed. So essentially he wants to know if he's going to be able to get this refund that has been deducted from his income. And I suppose what he's trying to say is that he does not have any tax liability as such. So Surabhi, how would you help Abhay out with his query?
So Abhay, your builder has done the right thing, because there is a section in the Act where the builder is required to deduct a certain portion of TDS. If you have no other tax liability, then yes, when you file your tax return on 31st July, you will be entitled to claim this as a refund. Please be very careful while you're filing your tax return. Show the fact that after the exchange, there was no taxable income. There is a column in the tax return form, both ITR 1, 2, which talks about TDS deducted. It'll pull that in straight from your Form 26AS, and if there is no taxable income, it will reflect as a refund in your tax return. Make sure that you fill out the bank details very carefully, and you should be able to get the refund back fairly quickly. So don't worry about this. The builder has done the right thing, and you can claim it back as a refund.
Okay. All right, Abhay, I hope your question has been answered. We are joined by Anand from Hyderabad right now on the phone line for a question. Hi, Anand. Good evening. Thank you for calling us. What's your question?
Yeah, my question is, I have a property sold after June 15.
Okay.
So the capital gains tax,
right.
Do we have to pay the advance tax now?
Okay.
It's after June 15.
After June 15. So you want to know whether you'll have to pay it now in the upcoming deadline. Fair enough.
Yes.
Surabhi, how would you help Anand out?
Yeah. Okay, so Anand, what you need to do is you definitely have to pay it, work out the capital gain. I'm assuming you're not reinvesting this under one of the section 54's 54F, and there will be a capital gain. You need to estimate the capital gain and pay off 45% by the 15th of September. Don't worry about the 15th of June deadline. You will not be charged an interest because your property was sold after 15th of June, but you now need to pay the 45% and then the 75% in December, and then the total tax by March. So please go ahead and pay according to these deadlines.
You know what, on that note, since Anand has brought up this whole sale of a home and the capital gains bit, and you mentioned section 54 and 54F, perhaps Anand may not be aware, but how can he save tax payments on those capital gains? If you could just very briefly touch upon that.
So Anand, you know, there are sections called rollover sections in the Income Tax Act, section 54, 54F, 54EC, which basically say that if you've sold a long-term asset, and you talked about residence, so I'm assuming that it's a long-term asset, then if you reinvest that in a property or in some bonds, etc., within a certain time period, either before or after the sale, then you can actually save the entire amount of capital gains. It can be considered as non-taxable. While I'd like to give you more details, but given the time, please read up section 54, 54F, 54EC and those line of sections, especially if you're looking to reinvest, because you may be able to save this capital gain, and if you think you are able to save it, then you don't even need to pay any advance tax as on 15 September.
Anand, you've taken note of those sections. Do read them up. Surabhi, really appreciate you joining us for this comprehensive wrap of advance tax, how to calculate it, and also who is liable to pay, and of course for helping all our viewers out with their questions and queries. Well, we'll take a very quick break right here on The Money Show, but when we come back, we are going to be proving the power of compounding with a comprehensive research report which says that the longer you SIP, or rather you pay your SIPs, there could be the possibility of positive returns that only increases to, well, almost 100%. More on that when we return. Hi everyone, welcome back. You're watching The Money Show on ET. Now, just before the break, we were talking about advance tax and who is liable to pay the same. Now we are going to talk about how it's important that you go for a SIP when you want to invest in the equity markets for the long haul. Here's a very interesting research report that proves that the probability of getting a negative return from your SIP investment becomes almost nil from the 5th year onwards. This is what the report suggests. If you are doing a SIP only for 1 year, then there's a 25% probability that you may lose your money, or essentially speaking, the value of your SIP has decreased, has become lesser than what you have put in. But as the years progress, it decreases. So it's 17% if your SIP is for 2 years, 8% if it's for 3 years, 5% if it's for 4 years, but 5 year and on, the probability of getting negative returns is close to 0%. And if you will look at fact sheets as well, that mutual fund companies do put out on their websites on a monthly basis, you'll notice that the 5-year CAGRs are positive and the 7-year CAGRs are even better. Like we say, SIPs and mutual funds are a long-term wealth creation instrument, and you must be in a SIP or a mutual fund only if you are going to be invested in the long haul. In fact, there are various other interesting findings as well of this report. To talk about it, we have with us Bhushan Kedar. He's one of the authors of this very interesting report. Bhushan, thank you for joining us on The Money Show. You know, the report is basically sending across that message of long-term investing, but this time around it's doing it with the help of numbers, which is always more convincing. So tell us, is mutual funds then, or are SIPs then, to be done only by those investors who want to be in the industry or who want to be investing for the long haul?
Yeah, absolutely. So investment and wealth creation is actually for a longer horizon. It needs to be looked at from that perspective, because short-term markets are exposed to volatility, and it is important that the investors one, understand the markets well, and stay put with it for a longer period of time, and have a discipline around it to ensure that they get value creation or wealth creation over a period of time. So that's really the key message. And I think SIP is something that we've used as a tool which can really help the retail investor to of course, one is from a discipline standpoint, and two, very importantly, since no one can really time the market, maybe barring few exceptional investors, I think it is important to have that discipline. So I think that's why we're talking about long-term investment through a disciplined manner of SIP.
Bhushan, does this hold true for all categories of mutual funds, be it a small cap, a mid cap, large cap, multi cap, or would fund selection matter?
So firstly, across category, and the study that CRISIL has put out as part of the report highlights that investors, whoever has invested across themes, so large, multi-cap, small cap, mid cap, across categories, investors have benefited. And of course, the numbers that we put together are more aggregates. If you actually dissect the numbers, you will find different cuts, and you would find there are certain funds who are outperformers. There are certain funds who probably have shown a moderate stroke mediocre performance at times. So fund selection is very, very important. So one, no one can really invest in all funds all the time, because the cost significantly goes up, because we are talking about large number of funds. So it is important that you pick and choose funds to ensure that one, you benefit from the funds. It is not definitely fill it, shut it, and forget it kind of a philosophy one can really follow here. So fund selection is important, and continuous monitoring is extremely crucial.
A lot of the questions that we get, our viewers, are also related to bulk investing, because it's not necessary that everyone goes in essentially for, SIPs or systematic investment plans. So the question is, would it matter for bulk? Or actually, before I do that, I would also like to know that would it matter essentially that you sort of discontinue your SIP when the market is lower, because a lot of our viewers ask us that. So would you agree? Should they discontinue their SIPs when the market is lower? Then what does the research say about that?
So a couple of things. Firstly, since we're talking about a 15-year period here, and we are talking about across categories where the data has been aggregated, it basically also factors in investment through periods such as subprime crisis that we saw in 2008, where markets tanked almost by 40-45% at that point of time. Then we had maybe crisis in Europe, you had crisis in China. Probably some of them lasted for few months, some of them lasted for a year and a half also. Throughout these periods, people have invested, and if you had made a systemic investment at that point of time, the returns that one would have got are clearly, the numbers are there, and people have generated alpha. So it is important that to stay put. What is also crucial and critical, and we spoke about that, is the fund selection. So if you are facing, if it is an industry-wide issue, and basically your fund is taking a hit, maybe it's important to look at the fund and see that whether it is doing far more terribly than the industry, or it is in line with how industry is overall doing. If the answer is yes, it is doing fine, then probably makes sense to stay put. But your fund is showing a significant underperformance, then it's time for you to review that and see look at some other categories, some other fund. I think that is the decision point one has to really sort of evaluate.
Okay, a lot of our viewers also do bulk mutual fund investing, not SIPs, but they've just parked their money in different mutual fund categories across different AMCs. What does your research say about bulk mutual fund investing?
I think your observation is valid. If you actually look at the flows that you would have seen in July, August, you've seen 20,000, 18,000 crores worth of investment over and above the SIP book, which is about 8,500 crores. So yes, at an industry wide, yes, there are these data points that are to be seen. But if you actually look at very specific from an investor standpoint, his or her, user experience, it is critical. If you were to make a bulk investment, it is important that you should be able to time the market. And as I said earlier, it is very difficult to time the market because no one really knows what is really the bottom. At the same time, you are also looking at the, it's just not about entry, it also sometimes about exit. You want to exit from it. Can you really time exit also very well? I think these are, pertinent questions. So, from a bulk investing standpoint, one can benefit if you can time the market well, but as I said, it's difficult. SIP on the other hand, helps you invest through the cycles when the markets are lower, higher, and I think that is where a retail investor who probably doesn't get into doing detailed assessment of a stock or of a portfolio on a very, very regular basis, I think it's a good tool for them.
Okay, that's a very interesting observation, and that should come up for you on your screens in just a bit. And that's the difference between the maximum return and the minimum return in a mutual fund. Look at how the graph essentially goes, because the difference over here is minimizing as time passes. It really narrows down, as you increase the investment duration. So if you could just simplify what this means for our viewers, when you say that, difference between maximum and minimum is diminishing, what does it mean for all our individual mutual fund investors and SIP investors?
If you look at the maximum and minimum return, analysis that we have provided, it basically is, about a user or an investor experience. So what we have tried to do there is, and I'll just, try and explain it a little more detailed fashion. So if you are investing through SIPs for a defined period of time, you are investing for a year period, 2 year, 3 year, 5 year, and you go until, 10th year. If you were to pick up a user who would have invested at the lowest possible point and got out after a year or something at a highest point, the best one could have got is close to 100%. But at the same time, on the downside, you would have lost, say, about 60% or something at that point of time. So there's huge volatility one could really go through. If you are invested for a shorter period of time, you can get the upside. At the same time, the downside is also very, very high. So that's one. But if you are more disciplined over a period of time, and as you go beyond 3, 4, 5 year horizon, what you really see, the band is sort of narrowing. It's coming closer. It is, the other observation is even the minimum returns are in the positive terrain. So we say that beyond 5 years you really don't see negative returns. You start seeing it in positive return, and if you really look at the overall number, the min and max as it is closing out, you would typically see about the return hovering in the range of about 12 to 15%, and that's really the expectation the investor has from an equity market. So that's kind of expectation that they work with. So if you are making a disciplined investment over a longer period of time, the volatility goes down to the expected return that one has is expecting from equity as an asset class. You are the chances of you achieving that are far, far more higher as compared to the shorter time horizons.
Okay, Bhushan, thank you then for joining us. So folks, the longer you invest, the probability of your money being eroded because of market factors decreases, because do remember, SIPs are essentially you taking sips of the mutual fund or the equity market. So that sort of average outs your cost, and it diminishes the probability of your returns going in the negative. That's, of course, the power of compounding as well that's at work. Okay, there's another very interesting instrument out there, and that's the sovereign gold bonds. The new tranche is open, and it's open today. It's the last day. The question is whether you should be investing in it. Let's quickly bring on board Harshvardhan Roongta's opinion, and he definitely did give this one a thumbs up.
sovereign gold bond is just one additional offering wherein a person can invest and electronically hold gold in his portfolio. So all the benefits that arise out of investing in gold, so there could be an appreciation in price of gold which will reflect directly in his holding. So he does not need to really literally hold gold in physical form. So sovereign gold bonds are one of such offerings which enable you to invest in gold in electronic form. The other benefit, of course, is that the purity is guaranteed. So in case you're taking a coin or gold in a raw form, then you would always have questions in your mind about its purity. Well, if it's in the sovereign gold bonds, kind of a situation, then of course the purity is guaranteed again. The biggest advantage, if I may say, on with sovereign gold bonds, when you compare it with other electronic form of gold, so you have gold funds, you have gold ETFs, and sovereign gold bonds. The sovereign gold bonds will also give you an interest payment of 2.5% per annum, payable half yearly. So besides the fact that you will get the benefits of appreciation in gold prices, or if there is a depreciation, if the prices go down, so whatever is the actual scenario with regards to the price of gold, besides that, you're also getting 2.5% interest per annum. Now, some may think 2.5% is too less an amount, but look at it from another angle. There is other forms of holding gold, there is absolutely no returns. In fact, there is a cost that you will be incurring. So here you're getting 2.5% additional interest besides the appreciation of gold in price, rise in price of gold. So I think these are a couple of advantages, and every individual looking to invest in gold, and purely from investment, not from a point of view of self-consumption. So if it's investment as a part of your asset allocation and a portion of your investments in commodities, precious metals such as gold, sovereign gold bonds are the most superior form of product that you could add into your portfolio.
If you want gold exposure in your portfolio, sovereign gold bonds is the way. But hurry, last couple of minutes left really to subscribe. Break on the show, but when we come back, we're going to be getting you a glimpse into the life of the super rich, how they invest, how they spend their money, all of that when we return. Welcome back. You're watching The Money Show on ET. Now, this is our Spend with TMS segment, and this time we decided to get you a sneak peek of how the ultra rich are not only spending their money but also investing their money. Karunya Rao is joining me right now in the studios, and Karunya, Hurun has a very interesting and a very detailed report, I must say. Let's start off first with, let's say, a bit of a boring part, and that's the investing thing. How is it that the ultra rich of India are putting their money? What do they favor the most?
Well, there are different parameters when it comes to investing and investing philosophy and the kind of approach they have where they are investing. Real estate sees the most traction, nearly 30%. There's gold with 19%, stocks 17%, fixed income very, very low. I think the new rich or the young rich are not preferring fixed income as a asset class at this point in time, and funds is the least, lowest in the rank, 6.7% only. So I think they need to be more educated about investing in funds at this juncture, but real estate definitely seems to be the favorite. Let's flip that and see what are the risk approaches, or what are the approaches they take up. Philosophy of the rich. Avoiding risk, that's the top of their priority. However, they want to park their money in realty sector and in gold, etc. But yeah, they want to avoid risk. A majority of them want to. There's 29% who are unsure of what exactly their philosophy is. Perhaps they can benefit from watching The Money Show. There's active investments at 13.7%. There's taking risk. Nearly 13% of these rich people are willing to take risks, and passive is almost 8%. So this is the philosophy of the super rich.
The rich as well are risk averse.
Absolutely, they are. They clearly are. While they want to buy gold, while they want to invest in property, but they don't want to.
But I think that's why they're investing in gold.
Perhaps, because they want to stay away with any kind of volatility and any kind of external environment. So okay, this is back once again. Let's also these are some preferences.
There you go, virtual currencies.
Don't know. Well, almost half of the population that's investing are not sure what they're doing, what their preference is. There's Bitcoin 29%, Ethereum 8.7%, Ripple nearly 7%. Other things, well, 5.8 odd %. So this is their preference when it comes to investing in virtual currency. Bitcoin, well, it does seem like a bit of a surprise because it's second in the entire ranking. But yeah, most of them are not sure about virtual investment, virtual currency
Half
investment.
of them, in fact. And
Absolutely.
Bitcoin is, of course, the most popular virtual currency as well.
But
out
it does
there.
come as a surprise that it does not top the list.
Top the list, yeah. Okay. You know what? We're going to discuss more of this report in detail. Since we're talking about investment, let's take that conversation forward. Karanya, stay with us. We'll get spending habits as well. We have with us Anas Rahman Junaid. He's the MD and the Chief Researcher of Hurun Report India. Anas, thanks so much for joining us on the Money Show. Before I delve into all those details, do you think Indians are up trading? Do you think that the rich are buying more expensive stuff compared to maybe what you've been seeing over the last few years, Anas?
Clearly, the trend is the income levels are increasing in India, at least in the top 1%, and there is a increased trend towards consuming high value luxury goods in India. Somewhere down the line, India is yet to witness some of the more expensive products in the market, and we do quite often see that Indian luxury consumers traveling outside of the country to buy these goods and come back. And there are we are quite familiar to some of the household luxury brands, but there are quite a few other brands that we don't even know about, that these consumers know about, and they go to, let's say, France, pick that product up and come back, and we would not even know that it's a very expensive bag, for instance. So definitely there is a trend, but they're very choosy. They look at multiple things beyond the brand and so on.
You know, it's interesting that the ultra-rich still consider realty and gold as one of their favorite investments. I mean, have they cited their reasons?
Yeah, so real estate is quite it's a very common knowledge that Indian entrepreneurs or Indian investors normally prefer real estate as next possible bet for their investments, right, when they have a disposable cash. For instance, I was talking to one of the entrepreneurs for valuation purposes for the India Rich List, and so when I looked at the market cap of the business, it possibly didn't have a good year this year. But then when we looked at the real estate holdings, it's way beyond the valuation of the business. So there is a huge appetite even now for Indian entrepreneurs to invest in real estate. It's definitely one asset class that is continuously will definitely continue to have good traction over the next few years. But gold is a very unique thing to India. India is possibly one of the very unique economies in the world which has a very high consumption of gold. Very quite uncomparable to markets like, let's say, if you compare to China also, right? It's very different from Indian perspective. So there is multiple reasons: emotional attachment, or religious reasons, or gifting. Gold is considered auspicious in many ways, very important for Indian HNIs, not only for personal consumption but also gifting or investments in multiple things. So that could be possibly the reason.
Okay, very quickly, Karanya, now let's talk about their favorite brands. When the rich go shopping, what do they like?
Well, yes, definitely. Now comes the exciting part, the spending part. We're talking about the favorite car brand first. And of course, these are the ultra rich we're talking about. So Audi is the top of their list. BMW and Audi actually sort of have a tie, 15.5% each. There's a Mercedes-Benz with 13.6% as far as the top 3 favorite brands are concerned for the ultra rich. For travel destinations, where do they like to travel the most? Well, it's UK with 19% of voting. There's Italy 12.4% and Maldives 9.5%.
We do see a lot of celebs in London.
Exactly, and for those who say that Maldives is budget and you can do a quick getaway, well, they really like to indulge there, and that actually is one of their top 3 destinations to travel. Next up, favorite brands. This is something very exciting. A preferred fashion brand, it's a Burberry and Gucci, the top of the top names. For watches, they prefer Rolex. Well, are you surprised? I am not. Favorite jewelry brand is Tanishq as well as Cartier when it comes to the international jewelry brand. Very quickly then, most popular gifting options or gift ideas that they have for men and for women. For men, it's watches, of course, I'm not surprised at all, 44.1. Electronics is almost 20%, is wine, 5%.
about women?
A meager 5%. Well, for women, jewelry, well, are you surprised, Mubina?
Not
Whether
at all.
it's rich, middle class, ultra rich, whoever, jewelry has to top the list.
Right.
59%. Accessories and then
So
gift cards.
let's take forward that conversation with Anas. Then let's talk about then the brands essentially. What exactly is it then that the super rich were looking for when they chose the brands?
I think they're like any other, from an investment perspective, of course, they would look for, most important thing is how do they protect capital. That could be the first thing from a bank or investment wealth management perspective. And for banks like, let's say, JP Morgan or top global banks, they would possibly, it could be important for those entrepreneurs who are expanding outside of India and who are expanding, who are setting up global businesses. Now, good that you mentioned about Taj. It's a very it's very unique to India that we have a Indian brand who is #1 in the hospitality section. And I'll give you an interesting fact. In such a huge economy like China, they don't have a single indigenous hotel brand which is really top of the charts. But whereas India, we have a Taj and Oberoi and whole bunch of brands. So it's basically, to answer your question directly, it's more of depends on the sector. And if it's a wealth management company, it's about wealth protection. If it's a global bank, it's about how good a service is if they go international. If it's about hospitality, it could be services, experience, a mix of things.
So Anas, we have Diwali coming up, and let's say one of our viewers has a very rich cousin or a very rich relative or a friend. What should the gift then be for that rich friend or relative, male and female?
It's a very personal question. I think I would definitely go for something like a good watch. If you look at the survey, watches top the preferred choice of gifting. So I think watch could be an interesting gift, and that too, if you have a nice eye, if you get a good watch, which is like a limited edition, it possibly will only increase in its value than reduce when you resell it. So I think a watch could be a good gift.
Anas, thanks so much then for joining us. So there you have it, folks, a sneak peek into the lives of the ultra rich of India. We'll wrap it up then. Thank you for watching. Enjoy your weekend.